Gold feels safe because it is familiar. It sits quietly in vaults, quoted on screens, spoken about with reverence. For most people, gold represents stability, a store of value, something that protects wealth when the world feels uncertain. Silver does not feel like that. Silver is volatile, uncomfortable, too cheap to be respected, too chaotic to be trusted. It moves faster, falls harder, and embarrasses anyone who treats it casually. So investors tell themselves a story. Gold is serious. Silver is speculative. That story is no longer holding. Because while most people were watching gold do what it always does, silver began doing something far more revealing. It stopped following. It started leading, not loudly, not dramatically at first, but persistently. And when silver outperforms gold, it is never an accident. It is a signal that something deeper inside the system is shifting. This is not about choosing the better investment. It is about understanding which metal exposes stress and which one simply absorbs it. The ratio between gold and silver has been flashing warnings for years. Most people ignore it because it does not fit neatly into headlines. But ratios are how systems speak when prices alone are misleading. And right now, the gold-to-silver ratio is not describing opportunity. It is describing imbalance. The uncomfortable part is this. By the time silver visibly outperforms gold, the adjustment is already underway. The easy explanations are gone. The system has moved past comfort and into correction. This is not a story about silver winning. It is a story about gold no longer being enough. Gold and silver have always been linked, but not equally understood. Gold is passive. It sits, it waits, it preserves. Silver is active. It moves, it gets consumed. It disappears into the real economy. That difference matters more now than at any point in modern history. The gold-to-silver ratio is often treated like a curiosity, a number that traders glance at but rarely respect. How many ounces of silver it takes to buy 1 ounce of gold? 60, 70, 80, sometimes more. On the surface, it looks arbitrary, but historically, it has never been random. When the ratio is high, silver is cheap relative to gold. When it collapses, silver is repricing faster than gold, and that collapse only happens during moments of systemic stress. In the 1930s, during the breakdown of the global gold standard, the ratio compressed sharply. In the 1970s, as inflation destroyed purchasing power and trust in currency, the ratio collapsed again. In 2011, following the aftershocks of the financial crisis, it happened once more. Each time, silver did not merely rise, it accelerated past gold. Not because silver suddenly became more precious, but because gold's role was limited. Gold protects. Silver adjusts. Gold absorbs fear. Silver translates pressure into price. That distinction is subtle, but critical. Gold is held. Silver is used. When monetary confidence erodes, gold benefits first. It is the initial refuge. But when the stress moves from financial markets into the real economy, when it affects production, energy, infrastructure, and supply chains, silver takes over. This is the point most people miss. Silver is not just a monetary metal. It is a monetary metal trapped inside an industrial civilization. As long as demand was mostly discretionary, this dual role created volatility. But once industrial demand became structural, it created leverage. Today, silver is consumed at scale by systems that cannot function without it. Solar grids, electric vehicles, data centers, advanced electronics, defense applications. These are not cyclical luxuries. They are strategic priorities. Gold does not get consumed. Silver does. And that changes how each metal responds when pressure builds. When investors sense risk, they buy gold. When the economy itself strains against physical limits, silver reprices. This is why silver outperforming gold is not bullish in the traditional sense. It is diagnostic. It tells you that protection is no longer enough, that preservation is giving way to repricing, that the system is adjusting to constraints, not sentiment. This is also why the idea of the ratio returning to 30-1 or even 20-1 is not as extreme as it sounds. Historically, those levels appeared when silver was allowed to express both its monetary and industrial value at the same time. At a ratio of 30-1 with gold holding current levels, silver moves decisively into triple-digit territory. At 20-1, it implies not enthusiasm, but stress, the kind that forces rapid adjustment. Those numbers are not targets, they are consequences. Smart money understands this distinction. It does not chase silver first. It rotates into it after gold has already done its job. When holding gold no longer feels sufficient, when the problem is no longer financial, but physical. This is why silver often lags gold early in cycles and then violently outperforms later. It is not late. It is waiting for confirmation that the system has crossed a line. That line is not crossed when markets panic. It is crossed when economies depend on a metal they cannot easily replace. Gold remains the anchor. Silver becomes the pressure valve. and when the valve opens, it does not do so gently. Once silver begins to move ahead of gold, the narrative usually tries to catch up after the fact. Analysts talk about momentum, commentators point to speculation, explanations circle the surface, but the deeper reason is always the same. The system is no longer being stabilized, it is being rebalanced. Gold is designed to sit outside the economy. That is its strength. It does not depend on growth, it does not rely on production. It simply exists as a reference point for value when trust erodes. Silver does not have that luxury. Silver is dragged into the economy whether it wants to be or not. It is wired into the grid, embedded in machines, soldered into circuits, dispersed across infrastructure. When the economy expands in complexity, silver demand expands with it. This is why the current cycle feels different, not louder, deeper. In previous eras, silver's industrial demand could rise and fall with the business cycle. Substitution was easier, scale was smaller, the economy could absorb shortages without structural damage. That is no longer true. Modern systems are designed around performance margins that assume access to silver. Conductivity losses are not abstract. They translate into inefficiency, heat, failure rates, and higher costs. At scale, those losses become unacceptable. So when silver prices rise, industry does not exit. It adapts, pays, and passes the cost forward. Demand becomes inelastic. Gold never experiences this dynamic. It does not get squeezed by necessity. It benefits from fear, but it does not get trapped by growth. This is why silver can outperform gold so violently when the ratio begins to compress. The market is no longer choosing between two safe havens. It is repricing a constraint. The ratio itself tells this story quietly. When it sits elevated, it reflects complacency, confidence that systems will function as they always have, that supply chains will respond, that monetary tools will manage stress. When it collapses, it signals that those assumptions are failing. A move toward 30-1 does not require mania. It requires acknowledgement, a recognition that silver is no longer abundant relative to its role, that the old balance no longer clears the market. A move toward 20-1 is something else entirely. That has historically occurred when silver stops behaving like a subordinate asset and starts asserting its own gravity, when it no longer waits for gold to lead. At that point, gold is still valuable, still trusted, but it is no longer sufficient on its own. This is the moment many investors find unsettling. Because gold feels like safety, silver feels like exposure, and exposure is uncomfortable when outcomes feel less controllable. But discomfort is often where information hides. When silver outperforms gold, it is not inviting speculation. It is warning that the system is under more strain than gold alone can absorb. That strain does not resolve quickly. It either dissipates through reduced demand, increased supply, or higher prices. So far, the first two options remain constrained. This is why the silver story resists neat conclusions. It does not end with a target. It does not resolve with a policy announcement. It plays out through adjustment. Gold will continue to do what it has always done: preserve, anchor, reflect distrust. Silver will continue to do what it has always done when pressure builds: expose, accelerate, reprice. The ratio between them is not a prediction tool. It is a diagnostic instrument. And right now, it is diagnosing a system that is running hotter than most people realize. By the time that diagnosis becomes consensus, the repricing is usually well advanced. Not because markets are unfair, but because they respond to structure, not comfort. This is why the debate over silver versus gold often misses the point. It frames the situation as a competition, when in reality it is a sequence. Gold goes first because fear goes first. Silver follows when fear turns into constraint. In every major monetary or systemic transition, that order has held. Gold stabilizes perception. Silver destabilizes assumptions. What makes the current moment distinctive is how early silver began to diverge. Not after a collapse, not after a visible crisis, but during a period many still describe as manageable, controlled, temporary. That divergence is telling. It suggests that the system is not just absorbing shocks, but quietly accumulating pressure. Pressure that gold alone cannot release. Pressure that requires repricing something embedded in the real economy. And that something is silver. This is why dismissing triple-digit silver as unrealistic often reveals more about the framework being used than about the market itself. Those price levels feel extreme only if you assume the old ratio must hold, the old demand structure must return, and the old monetary stability must reassert itself. Those are assumptions, not laws. The gold-to-silver ratio has never been fixed. It has always been a reflection of circumstance, of which role matters more at a given moment: preservation or function. Right now, function is asserting itself. The economy is not asking whether silver is expensive. It is asking whether it is available. And that shift in question changes everything. Gold will remain a reference point, a store of value, a signal of distrust. but silver is becoming something else, a measure of how far the system has stretched beyond its material foundations. When silver outperforms gold, it is not a vote of confidence in risk. It is a signal that the margin for error is shrinking. That is why this story feels heavier than a typical market comparison, because it is not about preference, it is about necessity, and necessity does not negotiate. Whether the ratio compresses to 30-1 or 20-1 is ultimately less important than why it is compressing at all. The direction matters more than the destination. It tells us that the old balance is no longer clearing, that the system is adjusting in ways that feel uncomfortable precisely because they are structural. Silver is not outperforming gold because investors are suddenly brave. It is outperforming because the system is asking more of silver than it ever has before, and systems always pay what they must.